Earning £100,000 a year in Britain used to mean something specific. It meant security. It meant you had made it past the point where money was a problem. It meant the conversations your parents had at the kitchen table about whether to put the heating on or which bill to delay were finally behind you. Around 1 in 4 adults in Great Britain say they would be unable to pay an unexpected but necessary expense of £850. Many of them are working households, and some of them, a number that might surprise you, earn salaries that most people in this country would consider genuinely well paid. This is not a video about overspending. It is not a lecture about lifestyle inflation, avocado toast, or anything like that. Those videos already exist and they miss the point entirely. This is a video about a specific mechanism, a structural feature of how Britain taxes income in 2026. A feature that can make a salary people dream about feel less like a destination and more like a trap door. The number is £100,000, and the mechanism has a name. Let's talk about what a 6-figure life in Britain actually costs. Not the aspirational version, the real one. You are probably in or near London. Because outside London, a £100,000 salary is unusual enough that you would usually have options. Inside London, you are often in the middle of something stranger. A life that feels expensive but does not quite feel wealthy. Your rent, for a 1-bed or 2-bed flat in Zone 2 or Zone 3, nothing extravagant, is probably somewhere north of £1,800 a month, possibly £2,000. You justified it, you earn good money, then come the bills, council tax, energy, food, phone, broadband, insurance, car insurance, contents insurance, maybe health insurance, that direct debit for the gym you joined in January. The one subscription that somehow became 4. And then there are the ones people forget to mention. Your student loan. Because if you went to university in England after 1998, you are very likely still repaying it. And at £100,000, you are not repaying it gently, you are repaying it hard. Then your pension. You are contributing to it because you are financially aware enough to know you should be, but it feels abstract in a way your rent bill does not. And then, of course, you are paying tax. A lot of it. More than the headline rates make obvious. Here is what that means. On income between £12,571 and £50,270, you pay 20% income tax plus 8% national insurance. That is 28% effective. Between £50,270 and £100,000, you pay 40% income tax plus 2% national insurance. That is 42% effective. Those numbers are already significant. But at £100,001, the pound above the threshold, something else happens. Something many people on that salary do not even know exists. And it costs them thousands of pounds a year. Every year. We will get to that mechanism in a moment. But first, let's be honest about the landscape we are standing in. Here is the central question this video is going to answer. At what point in Britain does earning more money stop improving your life in a meaningful way? And why is that point not a gentle slope, but a cliff? Not. Is £100,000 a lot of money? It is. In absolute terms, it is a high income. Compared to the UK median salary of £39,039, based on the latest Office for National Statistics figure from October 2025, it is a significant amount. But that is not the real question. The real question is this: What does a pound earned at 100,001 pounds actually cost you? Not in lifestyle, in tax, in lost allowances, in the way a high salary interacts with a system that was not designed with your interests in mind. The answer changes how you think about salary negotiation, pension contributions, bonus timing, and salary sacrifice. Let's look at the data first. The UK median annual salary for full-time employees is £39,039. That is the latest figure from the Office for National Statistics Annual Survey of Hours and Earnings, published in October 2025. Half of full-time working Britain earns below it. Half earns above it. So £100,000 is not just good money, it is 2.7 times the median. By any fair reading, it is a high salary. And yet, the personal allowance, the amount you can earn before paying any income tax, has been frozen at £12,570 since 2021. It will stay frozen until at least 2030. That sounds technical. Here is what it means for a real person. If you got a pay rise this year, the portion of your salary that gets taxed has grown, not because you are richer in real terms, but because the threshold did not move with inflation. With inflation at 3.3%, every frozen threshold quietly pushes more income into tax, year by year, without a vote, without a headline. HMRC calls this fiscal drag. It is one of the government's most effective invisible taxes, and it operates at every income level, including yours. But the mechanism we are focusing on today operates in one very specific band. The income range from £100,000 to £125,140. In this range, the effective marginal rate is 62%. Not 40%, not 45%, not even the 60% figure you might have heard mentioned. 62%, once you include national insurance. For every extra pound you earn between £100,000 and £125,140, you keep 38 pence. You earn £1. You keep 38 pence. We will explain exactly how that happens in a moment, but I want to give you one more number first. The average rent on a two-bedroom home in the UK is now around £1,257 a month. In London, for a one-bedroom flat in Zone 2 or Zone 3, you are usually paying meaningfully more than that. If you earn £100,000 in London, rent alone is consuming a larger share of your after-tax income than many people outside the capital would believe. That is not a moral judgment. It is arithmetic. And when you actually run the arithmetic, it produces a number at the end of the month that should make anyone stop and ask, where did all that money go? Here is the belief this video is taking apart. The belief is simple. 6 figures is the finish line. It is the salary you work towards. The benchmark people use when they talk about financial success in Britain. When I am on 6 figures. You have heard that phrase. You may have said it yourself. It implies that once you cross that threshold, money stops being a source of anxiety. You have earned your way out of the problem. The data does not support this, and I want to be very clear. This is not the fault of the people who believe it. This belief was taught. It is reinforced constantly by culture, by job adverts, by salary conversations, and by the fact that almost nobody explains what a gross salary actually means after the system has processed it. We compare gross figures, always gross, job adverts, salary negotiations, conversations with friends. It is always the number before anything happens to it. But you do not live on the gross number. You live on what is left. And the gap between what is printed on your offer letter and what appears in your bank account every month is where the illusion lives. What nobody tells people earning around £100,000 is this. You have arrived at the part of the British income tax system that takes the largest share of your marginal earnings, not because you are being punished, not for any clear moral reason, but because of a technical quirk in how the personal allowance is withdrawn, and it costs a lot. Let's start with what most people know. You have a personal allowance of £12,570. You pay no income tax on that. Then you pay 20% up to £50,270. Then 40% up to £125,140. Then 45% above that. That is what the HMRC website shows. It is accurate. And in one specific way, it is deeply misleading, because it does not clearly show what happens to your personal allowance when your income rises above £100,000. For every £2 you earn above £100,000, you lose £1 of your personal allowance. By the time you reach £125,140, your personal allowance has been completely withdrawn. Zero. Gone. Think about what that means. You are earning in the 40% tax band. You already knew that. But because your personal allowance is being removed at the same time, you are effectively paying tax in two ways on every additional pound in that band. 40% on the income itself, plus another 20% effect from the personal allowance you have lost. Income that used to be tax-free is now being taxed at the basic rate. And then there is national insurance. Above £50,270, the national insurance rate is 2%, 40%, plus 20%, plus 2% national insurance. That equals 62%. The effective marginal rate across this band is 62%. That is not a marginal rate you see anywhere else in the British income tax system. The 45% additional rate that starts above £125,140 is actually lower than the rate you pay in the band below it. HMRC does not headline this. It is not hidden. It is technically published. But it is buried inside the structure of the system, rather than surfaced clearly. Most people find out about it from an accountant, or they do not find out at all. Now layer fiscal drag on top of this. The personal allowance has been frozen at £12,570 since 2021. Inflation over that period has run significantly above zero. The £100,000 threshold has also been frozen since 2010. So in real terms, the salary where this 62% rate starts to bite is falling every year. Not because HMRC changed a number, because inflation is quietly pulling more people into the band without anyone having to vote on it. When the threshold was first introduced, a six-figure salary was genuinely uncommon. In 2026, especially in professional services, technology, finance, law, or medicine, in or near London, it is a salary a considerable number of people now earn. The mechanism that was once a niche quirk has become a mainstream trap, and for some people in this income band, there is one more layer: student loan repayments. If you are on Plan 2, meaning England and Wales, starting university from 2012, you repay 9% of earnings above £29,385 in the 2026 to 2027 tax year. On a £105,000 salary, that is 9% on £75,615, roughly £6,805 a year, about £567 a month. It leaves your bank account quietly through payroll, listed on your payslip below the fold. Add that to the 62% marginal rate, and income inside the £100,000 to £125,140 band can face a combined marginal deduction of 71%. For parts of that salary, you are keeping less than 30 pence in every extra pound earned. The number on your offer letter is real. It is just not the number your life is built on. Let me introduce you to Jamie. Jamie is 38. He lives in a rented one-bedroom flat in Clapham. His rent is £1,950 a month. He is a software engineer at a mid-sized fintech company. His gross salary is £105,000. He got there through a decade of working hard, switching companies twice to get salary increases, and consistently upskilling. By most measures, Jamie is doing well. He does not feel like he is doing well. At the end of most months, Jamie has around £900 in his current account. Not £900 in savings. £900 before the next direct debits hit. His actual savings rate, the percentage of income he's accumulating as wealth, is somewhere around 4%. Financial planners often recommend saving or investing 15 to 20% of your gross income across your working life to build a meaningful retirement pot. At 4%, Jamie is not on that track. He knows this. He has thought about it. But when he looks at his salary, £105,000, and then looks at his bank balance, the gap does not make sense intuitively. It makes complete sense when you run the numbers. Let's slow this down, because this is where the illusion breaks. Jamie earns £8,750 a month before anything happens to it. After income tax, accounting for the personal allowance taper, he pays about £2,536 a month in income tax. National insurance takes another £343 a month. That includes 8% on earnings from £12,570 to £50,270, then 2% above that. His plan. 2 student loan costs about £567 a month based on the 2026 to 2027 threshold of £29,385. Then he sets aside an amount equal to 5% of gross pay for long-term retirement savings. That is about £438 a month. His employer also offers a 3% match if contributions are structured through the workplace pension. For this baseline, we are treating £105,000 as Jamie's adjusted net income before deliberate pension planning. Pension contributions can reduce adjusted net income depending on how they are made. That includes salary sacrifice and grossed-up relief at source contributions. So to keep this baseline clear, the £438 line is shown as a cash flow retirement set aside, not as a tax planning adjustment. The tax-optimized version comes later. After income tax, national insurance, student loan, and this 5% retirement set aside, Jamie's flexible monthly cash is about £4,867. That is the number, not £8,750, £4,867. Now look at his fixed costs. Rent for a one-bedroom flat in Clapham, £1,950. Council tax, Band D, Lambeth, £171. Energy, £135. Groceries, £280. Phone and broadband, £70. Transport, monthly Zone 1 to Zone 3. Travel card, £202. Car insurance and parking, £90. Contents insurance, £25. Gym, £60. Subscriptions, including Netflix and Spotify, £35. Total fixed costs, £3,018. Take that from £4,867. Jamie has £1,849 left per month. On £105,000 gross. That is before dinner out, before visiting his parents, before a weekend away, before replacing a laptop, before a dental bill, before a car repair, before a flight home for a funeral. This is not a story about Jamie being reckless. He does not take extravagant holidays. He cooks at home most nights. He does not have a car on finance. He is not burning money on things he does not need. He is caught between a high fixed cost environment and a tax system that takes a disproportionate share of the income that was supposed to make that environment comfortable. And he did not know until he ran the numbers. Let's put the full calculation on one page. Jamie earns £105,000 gross per year. For this baseline, that is treated as adjusted net income before any deliberate pension planning to reduce the £100,000 taper problem. In real life, qualifying pension contributions can reduce adjusted net income depending on the method and the grossed-up amount. Here, the £5,250 line is shown as a cash flow retirement set-aside only. The tax-optimized pension structure is what we explore in Path B. Step 1. Income tax. At £105,000, Jamie's personal allowance is reduced by £2,500. His income exceeds £100,000 by £5,000, and £1 of allowance is lost for every £2 above the threshold. So his effective personal allowance is £10,070. His taxable income is £105,000 minus £10,070. That equals £94,930. Tax on the first £37,700 of taxable income at 20% is £7,540. Tax on the remaining £57,230 at 40% is £22,892. Total income tax is £30,432 per year. That is £2,536 per month. Step 2. National insurance. National insurance at 8% on earnings from £12,570 to £50,270 is £3,016. National insurance at 2% above £50,270 is £1,095. Total national insurance is £4,111 per year. That is £343 per month. Step 3. Student loan. For Plan 2, repayment is 9% on earnings above £29,385. On £105,000, that is 9% of £75,615. That equals £6,805 per year, or about £567 per month. Step 4. Retirement set aside. 5% of gross pay is £5,250 per year. That is £438 per month. Now put it together. Income tax, £30,432 a year. National insurance, £4,111 a year. Student loan, £6,805 a year. Retirement set aside, £5,250 a year. Total deductions and set aside, £46,598 a year. £3,883 a month. Take home after tax, national insurance, and student loan is £63,652 a year, £5,304 a month. After the 5% retirement set aside, flexible cash is £58,402 a year, £4,867 a month. Then fixed costs take £3,018 a month. So the real surplus is £1,849 a month, after tax, after national insurance, after student loan, after a 5% retirement set aside, after London rent and bills. Jamie retains about 21% of his gross salary as discretionary income, on 2.7 times the UK median salary. That number, 21%, is what the illusion is made of. Now imagine two versions of Jamie. Same salary, same flat, same city, different decisions. Path A is the default. Jamie changes nothing. He keeps setting aside the equivalent of 5% for retirement and gets the employer match. But he does not structure his contributions to bring adjusted net income below £100,000. He keeps his income inside the taper problem. He is not doing anything wrong. He is just not doing the thing that changes the maths. Over 5 years, on his current surplus and savings trajectory, he accumulates roughly £18,000 in savings. That is about £3,600 a year, net of the occasional expensive month. His own employee contributions add up to roughly £26,250 over 5 years before investment growth. With the 3% employer match included, total combined contributions are closer to £42,000 before investment growth. His total wealth position improves, but slowly. He still does not feel financially free because his monthly experience is the same: good income, unremarkable surplus. Path B is different. Jamie makes 3 adjustments. First, he increases his pension contribution to 12% via salary sacrifice. This does 2 things. It reduces his pensionable pay, and if he can get his adjusted income below £100,000, he exits the 62% effective marginal rate band entirely. His employer national insurance saving may also pass through as an additional contribution, depending on the scheme. On a rough calculation, putting an extra £5,500 a year into pension through salary sacrifice could cost him approximately £2,190 in reduced take-home, while building £5,500 of pension wealth. That is because the saving exits the 62% taper band, not just the standard 40% band. If student loan deductions also fall, the cash flow cost could be even lower. Second, he starts using his individual savings account allowance systematically. Maybe not the full £20,000 immediately, but enough that his surplus has a job before lifestyle absorbs it. This money grows free of capital gains and dividend tax. Third, he has a conversation with a qualified financial advisor about bonus timing and tax year planning. One piece of advice here could save him thousands in a single year if he receives a bonus that pushes him deeper into the 62% band. Over 5 years, Path B produces a materially different savings position. Not because Jamie earned more, because he stopped losing so much of every marginal pound to a structure he did not understand. The system was always going to offer this option. He just needed to know where to look. Here is the one thing I want you to take from this video. One sentence. Your salary is not your power. Your surplus is. The gross number on your offer letter is a negotiation figure. It tells you what you are worth in the labor market. It does not tell you what your life will actually cost, and it does not tell you what you will actually keep. Surplus is the number that matters, the money left after the system has processed your income, after your fixed costs have been paid, after real life has taken its share. Everything else is noise. Here is what I want to leave you with. We were sold a story about income. The story goes like this: work harder, earn more, reach the big number, and the anxiety stops. The story is not entirely false. More money does solve problems that less money cannot. But in Britain in 2026, a high salary is not the same thing as financial security. A high salary is an input. Financial security is an output. And the machine that converts one into the other is not neutral. The tax system, the cost of housing, the frozen thresholds. The student loan plan you were enrolled in before you were old enough to understand compound interest. All of it extracts from the number you thought you had. A six-figure salary in Britain today can mean the most aggressive marginal tax rate in the income spectrum. 62% effective in the £100,000 to £125,140 band. It can mean the highest housing costs because you have had to cluster near the cities where those salaries exist. It can mean the full student loan repayment rate. And it can mean a cultural expectation that you are fine, that you do not need to worry, because look at the number. But wealth is not the number on your offer letter. Wealth is what remains when the system has finished with it. In Britain in 2026, for a lot of people at this salary, that remainder is smaller and harder to grow than anyone told them it would be. That is worth knowing. I want to ask you something genuinely. What does your actual monthly surplus look like? After real bills, real deductions, real life. Not the theoretical budget you made in a spreadsheet at 11 at night. The real number, the one in your bank account on the last day of the month. Put it in the comments. Just the number if you want. Nothing else. I read all of them. And if what we talked about today rang true for you, if you found yourself nodding in places you did not expect, subscribe. We publish every week. Same channel. No glossy version. The real one.